Hey everybody, Randy Patrick here. Time for Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns, or some of you guys are saying As It Burns. And it's happening right now. Today is Thursday, June the 6th. Hope you're having a great day. We got a lot to talk about. This is probably going to be a bit of a longer video if I try not to talk too fast here. A lot has happened the past couple of days, lots to get into. So I learned something new yesterday, and I think this is very, very interesting, which kind of sets the stage for what's happening in our marketplace. So this is an article, and I'll post a link to this in the information section of the video here. But essentially, it's the economy that's jumping the shark. And real estate is now the largest industry sector of the U.S. economy in terms of value-added output, now surpassing manufacturing by 0.08% of GDP, which I believe stands for gross domestic product. So real estate is now the largest industry as a percentage of GDP. So when you actually take a look at the chart, you can see how real estate has overtaken manufacturing. So it's the biggest economy sector right now here. Real estate, rental and leasing account for 13.3% of the GDP, and I guess you could say that manufacturing only accounts for 11.4% of the GDP. So there you go. So there's a certain, so obviously real estate's overtaken that, which is interesting, and maybe it's a little bit scary as well too. So the real estate and rental leasing section of the GDP is based on real estate, which is housing, other real estate, which could be things like appraisal services and other real estate things, rental and leasing services, and lessors of intangible assets. So there you go. So really take a look at it. That's the number one economy sector for, I guess, our economy for the country right now is real estate. And the interesting thing is that clearly now we know why everybody is sensitive to things like rates and stuff like that. This is no wonder why the economy and markets are so addicted to and can't live without low interest rates. The danger is, however, real estate sector is highly leveraged. It is a highly leveraged industry, and real estate deflation is what the feds fear most. So when you take a look at what's going on in the country right now and where the property values have peaked, and we've had interest rate issues the past few months, things are dropping again. Obviously, real estate deflation is what the feds fear most. Now I get it, because it means so much to the GDP, and that's I didn't realize that's the first time I've actually seen that, and I'm actually kind of shocked. So basically, it boils down to, I guess the comment is kind of funny. Where's here? It's supported basically. Where's the word? It says sorry guys, here, let me find it here. It says output by a bunch of real estate agents and house flippers. So that's what we got propping up the country here: real estate agents and house flippers. So there you go. So anyway, just an interesting little segue here. But again, that's totally news to me, and I didn't realize it was that big. And I can see now why certain motivation is to keep this running as high as possible. So I understand that now. All right, new news that came in late or early this morning. Atom Data Solutions released their, I guess you could say, their Q1 2019 U.S. home flipping report. And if I give you some of the highlights here, we had a 12-year high on the total dollar volume of homes that were flipped. Average flipping return on investment continues to decline, and gross flipping profits are down from last year. So basically, the report came out and showed about 49,000 single-family homes and condos were flipped in the first quarter of 2019. That's down 2% from the previous quarter and down 8% from a year ago, and that's a 3-year low. So just to let you know that. So flipping has taken a little bit of a hit there. The gross profit to flip, or I guess after the flip, was $60,000, down from an average gross flipping profit of $62,000 in the previous quarter, and down from $68,000 in Q1 last year, 2018. And it's the lowest average gross flipping profit since Q1 2016. And realize that we're talking gross flipping profit. So you bought it for X, you sold it for Y, and there's your gross profit. It doesn't talk about your actual true profitability, costs, rehab, closing costs, stuff like that. I mean, so again, realize that that's a gross number. It's not a net number here. So, and the comments are, with interest rates dropping, home prices starting to ease, investors may be getting out now while the time is good before the market softens further. While the home flipping rate is increasing, so the number of homes that are being flipped is going up, gross profits and return on investment are starting to weaken, and the number of investors that are flipping is down 11%. So there's, I guess, less investors flipping, believe it or not. Therefore, investors are seeing a profit margin drop. They may be acting now, and selling before price increases drop even more, which seems to make sense. Home flipping rate up from a year ago in 62% of local markets, so more flipping is going on in specific markets. Home flip lending volume is up 35% to a 12-year high. So the total volume, total dollar volume of financed home flip purchases was $6.4 billion for homes flipped in the first quarter of 2019, up 35% from last year, and it's the highest level since Q2 2007. So it's over a 12-year high. So basically, obviously, more people are going to lenders to get the money to buy and flip and fix and flip these homes, which obviously, going back to our GDP a few minutes ago, so you can see why this is such a huge issue for the economy, that we need all this to keep going, apparently, because it's the largest sector here. So very interesting. Average home flipping returns continue to slip. So as I mentioned, every quarter now we're seeing less and less returns, which would be less and less profitability. And the average time to flip nationwide is 180 days. This has been hovering around 175 or 182. So basically, it takes 6 months to do a deal. And just a point I like to make. So I have a little real estate investment club here in the greater Tampa Bay area that I have meetings roughly once a month or so, and I had one yesterday, and we talked about this with respect to losing value on homes and doing home flips, and the issue that you could be caught and exposed if something happens. So you've heard the term, maybe you haven't, but the term is called ARV, after repair value. So what a lot of wholesalers or people who are trying to sell real estate to investors will say, well, here's the cost of it now. Obviously, there's going to be some rehab and some cosmetic or whatever it is you're going to do, but your ARV, so your after repair value, is going to be much higher than your purchase price, and therefore that's your profit margin ability right there, or availability. So the problem, though, is that ARV is typically it's a predicted value by somebody, typically the person trying to sell the property to you or wanting you to buy a property and earn a commission. And values are calculated by comparables, and comparables are closed sales. And closed sales are sales that have happened, similar homes in similar areas, maybe 30 days ago, 60 days ago, 90 days ago, maybe even 4 to 6 months ago. So people who are showing property or wanting you to purchase this home and telling you there's an after repair value, an ARV of a good number over here, they're going back in time to find comparables. Sometimes they stretch from distances, and they try to look at per square foot values and sort of work the calculation to look for a nice, attractive number for you as the investor. So my concern for everybody is the fact that you're being told a ARV, which is a totally predicted subjective number that can change at any given time, and they're using past comparables to predict what the future will be. Now, I've just mentioned the fact that the average time to flip a property is 6 months. So if you think about this, you buy a property today that's going to be a fix and flip project, you're being given an ARV that's based on comps that have happened 30, 60, 90 days or more behind, and that number is being used to predict in the future, which we know is going to take you 6 months. And now you're in a situation where we know that values have plateaued. In some markets, values have actually declined a bit, and now you have to risk what that number is going to be in the future. So for me, that's an example of a very risky investment, and you got to watch that, because we're at this point right now where everything I see is more volume, plateauing sales, more inventory coming out there. We've got decline in home prices, and we've seen appreciation slow down in many locations, an actual decline in prices. So for you to look 6 months down the road and predict you're going to make all this money, you may be in for a rude awakening depending on where you live and what your market says. So just keep that in mind, folks. That's why I find this this flipping information, which, listen, it's great to fix and flip property. There's nothing wrong with that. It's a great business if you can do it The key, though, is being direct to seller and having that opportunity to mess with the margin as opposed to buying it from somebody else where they've taken the margin out of it. So just keep that in mind, everybody. So that's kind of the scoop there. Now, inventory pile up is creating some better markets for home buyers and different markets across the country. The scales are tipping now. It's becoming more of a buyer's market, which is great. There's now, so this came out the other day from Realtor.com. They've got like a top 10 market for home buyers right now. And I'll run through this. And obviously the comment is, the home selling or buying markets largely favored sellers over the past couple of years. We're certainly seeing some shift now. Slow sales pace is allowing more property to stay on the market longer and giving more choice to people. We know that inventory growth has broken double digits. They say here that we see active buyers are seeing an active inventory grow at a rapid 14.6% pace year over year compared to the national growth rate of just 4%. And again, that's in these 10 locations here. So these 10 locations, for a reason, are seeing inventory growth, which is kind of interesting. So if we take a look at them, this is how it's going to change. Excuse me. Home price growth has hit a wall, and the top 10 markets for home buyers, starting from number 1, is the Albany, New York area. Months supply of inventory 6.4 months, and that's a 31% year-over-year supply. Median sales price has not increased year-over-year. Chicago, Naperville, Elgin, obviously Illinois area, 5.9%. I guess you could say month supply. This month supply have only grown 1%, and prices have listing prices have grown by 5%. Median sales price hasn't grown at all. San Antonio area, 5.7% months. Month supply has grown by 5%. Listing counts up 13%. Median sales price up 3%. Jacksonville, Florida, again, 5.6% month supply. Listing count up 13%. Median sales price up 4%. There's more here. There's Riverside, which is next. Los Angeles, California, Providence, Rhode Island, Dallas, Fort Worth area, Nashville area. And I'll post a link on this so you can take a look. And of course, where I live, Tampa, Florida, which has 4.1 months supply, 9% increase, 14% increase in active listings, and our median sales price actually went negative. So a lot of these here, these top 10 have 0, 0, 3, 4, 2, 1, 3, 0, 2, and Tampa is the only one on this top 10 that according to Realtor.com, has posted a negative 1%. Reduction in price. And again, it's the metro. It's Tampa, St. Petersburg, Clearwater, Florida. So that's our whole little Bay Area here. So I find that very interesting. But excuse me, again, pointing to the fact that, housing has cooled off. And, we're not out of the woods yet, but people are not coming to the forefront to buy and pay prices. And sellers have to understand now that they can offer lower prices, but buyers are still going to wait them out, and that's the new plan now. Everything I'm reading out there is saying, hey, we're seeing more inventory. That's great, but the buyers still are not coming forward because they want to wait and they want to push it and they want to get the best deal possible, which is their right, I suppose. So there's nothing wrong with that. So sellers are going to have to wake up and be a lot more aggressive. So having said that, there's always a debate with respect to home price appreciation and where it's going. I predict and I believe that we've already peaked a couple of times now and we're seeing decline. I mean, if you take a look at Case-Shiller, take a look at the stuff Redfin puts out and whatever, we see the trends are going this way. It's very obvious. We see that there's support information such as less pendings, more inventory, all those things now are showing the fact that the housing market is slowing down. But funny enough, you still have groups that like to predict what home values are going to do over the course of the next year, and I'll talk about that right now. So basically, CoreLogic came out with their estimate and says home prices will increase 4.7% in the next year, says a new CoreLogic estimate. So I think that's very interesting. So they're basically saying from April 2019 to April 2020, we're going to see a 4.7% increase in home values, and that will be a faster pace than the 3.6% gain that happened from 2018 to 2019 in April. So How they calculate this, I honestly don't know. They have their numbers and they figure stuff out. But, to me, this completely bucks the trend. And the trending we see is less and less growth every month. So that, whatever it's 5%, it's 4 and change, it's high threes, it's low threes, it's in the twos. So we're seeing every month that year over year is getting less and less and less. We're approaching the zero. We're approaching the flat line right now. So interesting to see that they actually are the ones predicting the most growth. The Mortgage Bankers Association, so MBA, forecasts a 4.2% gain for U.S. home prices. Fannie Mae believes that puts it at 4%, and NAR, National Association of Realtors, projects a 2.9% gain. So again, clearly the people that are predicting a home gain have their industry and their income based on home sales. So to me, it's not a surprise that you've got people saying, don't worry about what's going on. It's a blip in the marketplace, a small balancing act right now. Slow down. We're going to see everything pick up next month, etc. So we'll have to see. But I don't see that personally. I think, the trend's already there and we're seeing that. So again, CoreLogic, what do? They're a data provider. They sell lots of data services and they support a lot of MLS functions behind the scenes, a lot of the data that the MLS uses to predict that does their work, comps, whatever the stuff that goes on and through the MLS, and other data service providers use CoreLogic, either software or data, etc. So CoreLogic has clearly a vested interest in having, wanting to say home prices need to increase or will increase until we predict it. Obviously, Mortgage Bankers Association, that's mortgages. They obviously want us to believe that we should buy now and get a mortgage now. Why? Because home values are going to go up 4.2%. So why pay more next year when you can buy it right now? That's the thought process. Clearly, Fannie Mae's the government wants you to buy because why? They're going to underwrite those loans that the mortgage providers are going to write. And NAR, of course, which is, I have to say, NAR, 1.357 million realtors out there, actually has the more, I guess you could say, conservative growth at 2.9%, which I find is, that I can kind of go, okay, that I can see where they may have come up with that number. I mean, clearly, a lot of people out there are saying it's not going to happen. We're not going to have growth. We're going to see a decline going on. But I just think it's very interesting that you see where everything's at. So I'm going to always point back to that first comment we made regarding the GDP and how real estate is such a huge component of the GDP. And that's why when I see that and I see everything that we talk about here now, it puts everything into perspective. It certainly does. So speaking of mortgage volume here, mortgage application volume increased last week, 1.5% last week from the previous week and 12% from the week earlier, a week earlier a year ago, according to the Mortgage Bankers Association. But the gains were driven by refinances rather than from home buying purchases. So a lot less, home purchase application origination as opposed to refis. So again, going back to what I said here, numbers don't lie. So you got people predicting increase in home values, yet we see that home purchases are going, or home purchase applications are dropping, which is an indication of future activity. Simple as that. So the interesting part, though, is that when refinances are up, now refinances tend to go up when rates are dropped. So when rates drop, which they have, the past week or so, rates hit another low point, you're going to see more opportunity for refinances. And part of the media reports saying, hey, when rates drop a certain amount, then X number million more people fall into that category where they could refi based on loan to value and things like that. So when rates drop, refis go up, which to me is also an indication that, if are you going to put your home up for sale? Maybe you're not concerned, or maybe you're concerned about sales activity and where the market's going to go, but as a stopgap measure, let's refi, pull some money out, and we've got cash to either do what we want with it. And some reports have actually saying a lot of people are refining their home, and the cash is being used to pay debt, not essentially improve or buy or invest or whatever. It's actually being used to pay debt. So just so you know, that's what's going on right now. So again, I see all these little signs are adding up as to what's going on in the marketplace. So to me, more refinances indicate that homeowners probably think that they can't sell or get their price. So They're going to hold on to their property and take money out and realize if you sell, get your price and sell, then where are you going to go, right? That's the thing. Are you moving up, trading up, or you're trading down? Trading up or moving down? And with prices still fairly unaffordable, you're not gaining when you sell, because that gain is going to be used to pay a premium for the next property you're going to purchase. So everyone's kind of stuck in this little area right now, which is kind of difficult to move out of. Which brings me back to the rental versus home ownership, I guess you could say, debate, question, etc. So if you mess with homes and involved in real estate, clearly, everybody has an opinion on whether it's better to rent or better to purchase, for your own personal situation. You got to figure that out. So Florida Atlantic University, I guess, has a study, a little economics area there, and so Florida Atlantic University and Florida International University put out a report that basically is rent versus buy. And what they've done is they look at 23 metro locations. So there's an index that they use, and the data that they've analyzed suggests that out of the 23 metro locations, that 19 are in rent territory. And this means that on average, an individual family in these cities would be better off renting and reinvesting in a portfolio of stocks and bonds, as opposed to building wealth through equity accumulation and home ownership. So there you go. So they actually have an index now, and so they're stating the fact that 20% down or money, whatever you'd put down, move it someplace else and have it work for you in the stock and bond market, as opposed to a down payment and home ownership and owning a home in these certain locations, because I guess they don't believe that the equity appreciation will return what you would return on stocks and bonds at this time right now. So basically, the opportunity to generate greater wealth by renting and reinvesting puts downward pressure on the demand for home ownership, and prices should follow sooner rather than later. So their comment here is that if it means you should be renting, then home ownership really is difficult in that area because of affordability, which means your money's not going to work for you if you buy. You buy today, you're probably going to lose your appreciation, whereas you could be making money by renting and putting that money as a down payment or whatever you would spend to buy the house, working for you in some other capacity. There you go. So the index of 1, it's a 1, 0, -1 index. So the closer you are to 1, the more pressure on home ownership, which means you should be renting. The lower you are to 0, it's kind of iffy, and below negative, if you're 0 to -1 in the index, that's an indication that you're better off buying in those marketplaces. So again, out of the 23 metros they looked at, only 4 were buys, okay? And the 4 buys were Cleveland, Chicago, New York, and Detroit. That's the ones that are in the buy territory. And the ones that they looked at were in the rent territory. There's 19 of them here. And again, it's only 23, so your city may not be here, but Dallas, Denver, and Houston were the ones that were closest to the top of the index, which suggested that you'd be better off renting and putting your money someplace else. There's a bit of a gap, and you got Seattle, Pittsburgh, Kansas City, Miami, Portland, San Fran, Atlanta, Los Angeles, San Diego, Philadelphia, Minneapolis, Honolulu, St. Louis, Boston, Milwaukee, and Cincinnati. They were all above 1, and as I said before, the 4 that were below 1, which means buy, Cleveland, Chicago, New York, and Detroit. So interesting that we've got people who are looking at this from different aspects now and creating other indices that can help you with your real estate investing or home ownership goals. I do find this interesting, and to me, it just again, it's one more supporting factor of what's happening in our marketplace, and that's what's going on here. So if you go back, a number of years ago to the last housing, boom, bubble, bust, and kind of crisis, there were a number of contributing factors that pushed everything over the edge. It's not just one thing, it's usually a number of things. And we're seeing a lot of those signs. Most of those signs are back now, and yet we've got more analysis happening, and it's interesting to show that, when they do their analysis, it's kind of like, I wouldn't be buying in Dallas right now. That's almost a top of the index for us. You're better off, renting and letting the price points come down, which will adjust the index. Then when the time is right, you should actually buy, because it's better than renting. So right now, it makes sense. Invest, but a funny thing though, they're not suggesting you invest in real estate. They're suggesting that their comparative is that putting your money in stocks and bonds as opposed to building wealth through equity from home ownership. So that's the difference there. Home ownership equity, stock and bonds, building money and wealth that way. So interesting to note that they're putting this stuff out. We're seeing more and more reports like this where people are questioning, questioning the need to spend money on real estate and spend money that's maybe out of whack or a little too expensive in various markets as well. So interesting to note, but again, one of yet many signs that I look at to say, hey, this is just a universe. It's totally academic. There's no, they're not buying houses or selling, software to, real estate companies or mortgages, whatever. Just an analysis right here. So unbiased analysis from an academic institute that's kind of telling us, well, in these locations, maybe we're a little too high priced. And to me, that's one more piece of information that shows that we need to have some correction here, and that's starting to take place, unfold as we speak. So anyway, everybody, thanks again for listening to all this. Appreciate the views, appreciate the comments and likes on the video. If you can share it, let others know that we exist. That'd be helpful, so please share the video on your Facebook, Twitter, whatever you'd like to do. Also, if you have real estate questions and concerns, drop me an email. My email usually is in the About section of the information on the video, so you can find my email there. You can hit me directly, and I'll certainly connect with you. There are a few people who last week or early this week did reach out that I haven't got to yet. It's been a busy couple days, but I'll start getting on that later on tonight, and we'll connect. So again, please subscribe too if you're not a subscriber. If you'd like to hear more from our channel, I've got more things planned that are really going to show everybody where our housing is headed and the driving forces that are pushing us through the bubble at this point in time. So again, thanks very much, and we'll look forward to doing one more of these next week.